$350 billion. On October 17th, Sam Altman, the man who built ChatGPT and understands where artificial intelligence is heading, helped secure $2 billion for Oklo, a nuclear fuel production company. Not solar panels, not wind turbines, nuclear fuel. Amazon announces construction of an entire complex of small modular reactors. The Department of Defense launches the Janus program to deploy nuclear energy at military installations. And while all this unfolds, the Energy Information Administration forecasts a uranium shortfall of £184 million by 2035. Today I'll show you the mathematics explaining why green energy has hit physical constraints. I'll explain why the world's largest technology companies are pivoting to nuclear power after decades of avoiding it. I'll break down the uranium supply chain and where the bottlenecks form. I'll show you sectors that could redefine the energy landscape over the next decade. And at the end, I'll cover one trap that'll catch most investors who think buying any stock with nuclear in the name is enough. Stay until the end. There's a question coming that'll make you rethink your entire portfolio. Let's start with the numbers that frame everything else. The United States is preparing to add 53 gigawatts of nuclear capacity by 2050. For context, total US nuclear generation right now sits around 100 gigawatts. We're talking about 63% growth over 25 years. Bloomberg Intelligence estimates the investment required for this expansion at $350 billion. 350. For perspective, that exceeds Tesla's market cap. That's equivalent to Denmark's annual GDP. When capital at this scale begins moving in one direction, smart investors don't ask why. They ask where exactly. Here's what drives this capital. Data centers. Every ChatGPT query consumes 10 times more energy than a standard Google search. Training a single large language model requires as much electricity as 10,000 homes use in a year. Data center loads in several US regions have already exceeded forecasts by 30 to 40%. Power grids in Virginia, where massive Amazon Web Services and Microsoft Azure capacity sits, face unprecedented strain. Utility companies warn that without new baseload generation sources, data center expansion will slow physically, not financially. This raises a question. What about solar panels and wind turbines? For the last 15 years, we've been told the future belongs to renewables. Green energy investments run into the trillions. Subsidies support the industry for decades. Politicians promise carbon neutrality through renewable sources. What changed? The consumption math changed. Data centers require stable power delivery 24 hours a day, 7 days a week, 365 days a year. The sun only shines during daylight. Wind blows unpredictably. Batteries can smooth fluctuations for a few hours, but they can't power a data center for weeks when weather doesn't cooperate with generation. Renewable sources work brilliantly for distributed grids with variable loads. Solar panels on residential rooftops, wind farms supplementing traditional generation. All of that makes sense. But when we're talking about a data center consuming 200 megawatts continuously, physics gets brutal. Either you have a stable baseload generation source, gas, coal, or nuclear, or the data center sits idle when the sun sets and wind dies down. Downtime means lost revenue. Lost revenue for a company the size of Amazon or Microsoft measures in millions per day. That's why they're pivoting to nuclear energy. On October 17th, Oklo announced a partnership with European company Nucleo to develop nuclear fuel production in the United States. Nucleo plans to invest up to $2 billion in this infrastructure. Sam Altman, who remains a major Oklo shareholder despite stepping down as chairman of the board in April, understands one thing better than most. Without stable energy, his artificial intelligence empire doesn't scale. OpenAI has already announced plans to deploy 17 gigawatts of computing capacity in partnership with Oracle, Nvidia, and SoftBank. 17 gigawatts. For context, that equals the output of 17 large nuclear reactors. Where will this energy come from? Altman understands solar panels won't cover that volume. Oklo is developing small modular reactors, compact units roughly the size of a shipping container that can generate between 1 and 15 megawatts. The concept involves mass-producing standardized reactors, bringing down costs through design repeatability. Traditional nuclear plants take decades to build, each one unique, each one costing billions. Small modular reactors promise to cut construction timelines to 3 to 5 years and reduce the cost per unit of capacity. Sounds attractive. The catch? None of these reactors have been built at commercial scale in the United States yet. The technology exists on paper and in demonstration projects, but mass deployment hasn't happened. And here's the critical point. Sam Altman's and Nucleo's investment in Oklo represents a bet on future production, not existing infrastructure. $2 billion flow into building facilities to produce fuel for reactors that haven't been deployed at scale yet. Why would anyone make that bet? Because they see inevitability. Demand for stable energy is growing exponentially. There are no alternatives. The regulatory environment is improving. In September, the US Department of Energy selected Oklo and 3 other companies for a pilot program to build nuclear fuel production lines. Federal support signals that government views nuclear energy as a strategic asset, not just a commercial opportunity. Amazon is moving in parallel. In mid-October, the company announced plans to build a complex of small modular reactors in partnership with X-Energy in Washington State. Not one reactor, a complex. Amazon Web Services consumes gigawatts of energy annually to support cloud infrastructure. Every data center expansion requires a reliable power source. The company has already signed renewable energy purchase agreements for tens of gigawatts, but that's insufficient for stable baseload. Nuclear energy becomes the logical complement. Google is moving in the same direction. The company is negotiating nuclear energy purchases for its data centers. Microsoft has signed contracts for power from nuclear plants. Oracle is participating in computing capacity deployment that will require nuclear sources. We're not seeing isolated experiments. We're seeing a coordinated shift across the entire technology industry. When the world's 4 largest technology companies simultaneously pivot to nuclear energy, that's a signal you can't ignore. On October 13th, the US Department of Defense announced the Janus program, an initiative to deploy next-generation nuclear energy at military installations. Why the military? Because energy is a national security issue. Every F-35 fighter requires more than 400 kilograms of rare earth metals for guidance systems, radars, and electronics. Producing these materials is energy-intensive. Every aircraft carrier, every military base depends on stable electricity supply. If an adversary can disrupt energy supply, they can paralyze military infrastructure. Small modular reactors solve this problem. They can be deployed at remote bases, providing energy independence. They're harder to attack than centralized power grids. They don't depend on fuel deliveries every few days like diesel generators. A single reactor can operate for years on one fuel load. For the military, that's a strategic advantage. The Janus program signals nuclear energy is transitioning from commercial infrastructure to critical national security systems. When the military starts building reactors, the investment community needs to pay attention. And now the crucial part, while all these investments get announced, while tech giants and the military pivot to nuclear energy, a fundamental problem emerges. There isn't enough uranium. The Energy Information Administration forecasts a shortfall of 184 million pounds of uranium by 2035. 184 million. For context, annual uranium consumption by all US reactors runs around 50 million pounds. We're talking about a deficit equivalent to nearly 4 years of full consumption. Where will it come from? Global uranium production sits around 180 million pounds per year. Demand, according to World Nuclear Association estimates, will grow by a third by 2030 and reach 150,000 tons by 2040. Current production already falls short of covering growing demand. Secondary supplies, reprocessed uranium from old warheads, stockpiled inventory at utility companies are depleting. The market increasingly relies on primary mining, but new uranium mines take 10 to 20 years to develop, from exploration to first production. When demand grows faster than supply can scale, prices rise. That's economic law, not analyst opinion. Uranium prices already reflect this dynamic. In early October 2025, spot prices exceeded $83 per pound. For comparison, in 2016, prices dropped below $20. Over 9 years, that's more than fourfold growth. Long-term contracts that utility companies signed to secure fuel for years ahead have increased 23% over the last year. Utility companies, according to EIA data, are delaying purchase decisions because of high prices, creating a dangerous cycle. The longer they delay, the more supply uncertainty grows, pushing prices even higher. Analysts estimate that 25 to 30% of utility company uranium requirements for 2025 remain uncontracted. That means a quarter of annual demand isn't secured by long-term agreements. Utility companies are forced into spot markets where prices are volatile and inventories limited. Cameco, the largest Western uranium producer, warns the market is underestimating deficit risks. Prices, in the company's view, need to be higher to justify investments in new mines. Until prices rise enough to make new projects profitable, the deficit will deepen. This is where the investment opportunity begins. When demand grows exponentially and supply linearly, companies controlling production become bottlenecks. Who produces uranium now? Who can scale production faster than others? Who controls enrichment, the process of converting natural uranium into reactor fuel? These questions determine where value forms in the nuclear chain. Most investors will chase stocks of companies developing small modular reactors, but reactors are useless without fuel. Fuel is the bottleneck. Whoever controls fuel controls the pace of the entire industry. Now I'll show you the uranium supply chain structure and where real opportunities hide. Stay with me. In a few minutes, you'll understand why 90% of investors are looking in the wrong place. The uranium supply chain consists of several links, and each creates a concentration point for value. The first link is mining. Uranium gets extracted from underground ore or through in-situ leaching, where solution gets pumped through rock formations to dissolve uranium compounds. Kazakhstan produces more uranium than anyone else, around 45% of global supply. Canada, Australia, Namibia, Niger, and the United States fill out the remaining share. The largest producers, Kazatomprom from Kazakhstan and Cameco from Canada, control significant market portions. These companies sell uranium to utility companies through long-term contracts and on spot markets. After mining, natural uranium contains only 0.7% of uranium-235, the isotope needed to sustain chain reactions in reactors. Most commercial reactors require enriched uranium with uranium-235 concentrations between 3 and 5%. The enrichment process is energy-intensive and technologically complex. Historically, enrichment has been controlled by a few countries because the technology energy links to nuclear weapons production. Russia, through Rosatom, controls around 40% of global uranium enrichment capacity. Europe, through Urenco, controls another third. The United States depends on imported enriched uranium because domestic capacity declined after the Cold War ended. Here's where geopolitical vulnerability forms. Russia enriches uranium for American and European reactors. After the Ukraine conflict began, the United States announced intentions to ban Russian enriched uranium imports, but the ban comes with exceptions because alternative suppliers remain insufficient. The Trump administration allocated $2.5 billion to build domestic enrichment capacity, but those facilities won't come online until late this decade. Until then, dependence persists. After enrichment, uranium gets fabricated into fuel rods that load into reactors. Fuel rod production is also concentrated among a few companies, including Westinghouse and Framatome. Then fuel gets used in reactors, generating electricity. Spent fuel either gets stored on site in specialized pools and containers or gets reprocessed to extract remaining uranium and plutonium. Reprocessing happens in only a few countries, including France, Russia, and Japan. The United States hasn't reprocessed civilian spent fuel since the 90s due to nuclear proliferation concerns. Every link in this chain, mining, enrichment, fuel fabrication, reprocessing, represents a potential opportunity or risk depending on how you approach it. Investors seeking nuclear energy exposure often only look at companies developing reactors. Reactors sound futuristic, small modular reactors sound innovative, but reactors depend on fuel. Fuel depends on enrichment. Enrichment depends on natural uranium. If any of these links narrows, the entire chain slows down. Right now, the tightest bottleneck is enrichment. Russia controls capacity. Europe has Urenco, but capacity utilization runs high. China is building its own capacity but sells domestically, not for export. The United States depends on imports and has only started rebuilding domestic production. Centrus Energy is the only American company producing high-assay, low-enriched uranium for military applications. It received a contract from the Department of Energy to deploy capacity for producing fuel for small modular reactors. Oklo and Nucleo are investing in building similar capacity. Whoever controls enrichment controls access to fuel. Whoever controls fuel controls the ability to deploy new reactors. Let's return to the deficit, £184 million by 2035. That figure is based on demand projections if all planned reactors get built. Many are planned. China is building more nuclear capacity than all other countries combined. India is expanding its program. Europe is reconsidering reactor closure plans after the 2022 energy crisis. The United States is returning to nuclear power after decades of stagnation. Japan is restarting reactors that were shut down after Fukushima. South Korea is ramping up capacity. All of this increases uranium demand. Supply lags. New uranium mines develop slowly due to permitting complexity, environmental constraints, remote deposit locations, and capital costs. Many promising projects got frozen after the 2011 Fukushima accident when uranium prices collapsed. Producers closed mines that became unprofitable. Exploration investment contracted. Now that demand is recovering, capacity is insufficient. Cameco, the largest Western producer, warns it'll take years to bring mothballed capacity back into production and even longer to develop new deposits. Here's where the math gets brutal. If new reactors start coming online faster than producers can scale uranium extraction, the deficit deepens. Prices will rise. Utility companies will compete for limited supplies. Producers with existing capacity will gain pricing power. Those controlling uranium assets now, operating mines, proven deposits, supply contracts, will find themselves in winning positions. Energy Fuels often gets mentioned in the American uranium context because the company owns the only operating conventional uranium mill in the United States. The White Mesa facility in Utah processes uranium ore into concentrate that then ships to enrichment. The company also mines vanadium, a rare metal used in energy storage batteries. As of mid-2025, Energy Fuels carries zero debt and around $250 million in working capital, providing financial flexibility to expand production if uranium prices stay elevated. Its US position matters because government is interested in reducing uranium import dependence for national security reasons. Uranium Energy Corp is another American company controlling uranium projects in Texas and Wyoming. The company uses in-situ recovery, which is cheaper and more environmentally friendly than conventional mining. UEC has licensed capacity ready to restart if prices justify production. As of late 2024, the company secured uranium supply contracts with utility companies exceeding $100 million, providing revenue once production starts. Cameco remains the dominant player in the Western world. The company owns the Cigar Lake mine in Canada, one of the highest grade uranium deposits globally. Cameco also holds stakes in enrichment facilities and fuel fabrication, giving it an integrated position in the chain. When uranium prices rise, Cameco benefits directly. The company also maintains strategic uranium inventories it can sell on spot markets when prices are favorable. Kazatomprom, the Kazakh state-owned company, produces more uranium than anyone in the world. Its shares trade on the London Stock Exchange. The company controls low-cost deposits using in-situ leaching, delivering high margins even at moderate prices. Kazakhstan is politically stable and economically interested in developing the nuclear industry globally because it supports demand for its uranium. Here's Here are 3 sectors worth attention. Uranium producers with existing capacity and low costs, companies controlling enrichment and fuel production, and small modular reactor developers with contracts from major buyers. The first category benefits directly from rising uranium prices. The second controls the supply chain bottleneck. The third bets on long-term energy transformation but carries technological and regulatory risks. Now the trap. Most investors will see nuclear renaissance headlines and start buying any stock with nuclear or uranium in the name. Shares of companies without production but with presentations about prospective projects will soar on hype. Small modular reactor venture projects will attract attention and capital even if they lack technological proof or regulatory approvals. Investors will buy the narrative rather than fundamentals. When the narrative weakens, and it will weaken because all narratives weaken, companies without real production, without revenue, without contracts will disappear. 95% of small modular reactor projects won't get built. The technology is complex. Regulatory approvals take years, capital costs are unpredictable, the first few projects will face delays and overruns as happened with every new nuclear technology in history. Investors who bought shares on hype will lose money. Those who bought companies with real assets, operating mines, supply contracts, integrated chains will survive corrections and profit when the industry stabilizes. The second trap is assuming green energy is finished. It isn't. Solar panels will continue getting cheaper and getting installed by the millions. Wind farms will keep growing. Batteries will improve and get cheaper. Green energy complements nuclear rather than directly competing in all use cases. Nuclear energy provides stable baseload generation. Renewables provide peak and distributed generation. Investors selling everything green and buying only nuclear will miss the nuance. The optimal strategy is exposure to both sectors, understanding each one's role in the future energy system. The third trap is thinking you have time. Altman invested on October 17th. Amazon announced plans in mid-October. The Department of Defense launched Janus on October 13th. Institutional investors have already started accumulating positions in uranium companies and nuclear ETFs. Retail investors typically arrive last when prices have already reflected most of the potential. The question is whether you want to enter when smart money is already positioned or when the masses start buying at the hype peak. Here's what you need to understand. The market doesn't wait until you're ready. The energy crisis is unfolding now. Data centers require gigawatts. There are no alternatives to nuclear energy for stable baseload generation. Uranium is scarce. Enrichment is controlled by a few players. Whoever owns assets in this chain owns the bottlenecks. Whoever owns the bottlenecks owns pricing power. Now the final question I promised at the start. The United States is preparing to add 53 gigawatts of nuclear capacity, 350 billion in investments, a uranium deficit of 184 million pounds. Sam Altman is investing 2 billion. Amazon is building reactors. The Department of Defense is launching the Janus program. Knowing all this, knowing the specific numbers, knowing the chain structure, knowing where bottlenecks form, here's my question to you. What percentage of your portfolio has exposure to the energy sector? 0, 5, 10, and specifically to nuclear infrastructure, to uranium, to enrichment? Write honestly in the comments. Are you already positioned or are you only now realizing the scale of what's happening? Because in 2 years, when we learn how this scenario played out, I'll come back and read these comments and we'll see who acted based on data and who waited for everyone else to start buying. You know what happens when everyone starts buying simultaneously? Prices already reflect expectations. Alpha disappears. If this analysis gave you information you didn't have, if you saw structure where you previously only saw headlines, share this video with investors who need context. Subscribe to the channel for breakdowns of market forces, energy transformations, and strategies that separate prepared capital from capital caught off guard. Check your portfolio today because the energy crisis is already here. The only question is whether you're ready for it. Thanks for watching.